Welcome to the Winner's Playbook. Every winner needs a game plan, and this one's for you. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal situation. Please head to the show notes if you wish to book in a free 15-minute call to discuss your personal situation.
Welcome back to the Winner's Playbook. Big week in Australia. The election is done and dusted. Today, I'm joined by our special guest, Belinda of Tax Invest Accounting. Belinda has over 2 decades of experience in accounting and works closely with individuals and business owners. Today, we will break down what the election results actually mean for your money. We're not getting political, we're getting practical. From potential tax changes to business impacts and what everyday Aussies should watch out for, will help you make sense of what's next and what, if anything, you should be doing with your finances. Let's get into it. Welcome, Belinda.
Hi, thanks for having me.
Yeah, pleasure to have you. So let's jump right into it. What are some of the biggest financial policy changes we might see after the election?
Okay, so one of the pinnacles of their promises is actually the HECS help debt changes. Now, this is a massive part of their policy. It's actually a $19 billion cost, and it's going to overhaul HECS and help debt as we know it. So the first thing that's going to happen is before June 1, so annually on June 1, indexation is applied to all outstanding debts. So prior to this, the government is actually going to wipe out 20% of all outstanding debts from every student loan. So when we say HECS help debt, we mean absolutely everything included. It's HECS, it's HELP, and it's the income contingency loans such as SSFS, VET, fee help, all of it. So if you have a student loan and there's an outstanding balance, you will see 20% wiped off of this before June 1, before that indexation is applied. Now, there's nothing for any taxpayer to do. The ATO will do this automatically.
Okay, so that's huge. So is that happening like this 1st of June coming up in a few weeks? Do they have to
Yes.
legislate it first, or are they able to do that?
They are going to be legislating it, but it is one of the first things that they're going to do. And because of the majority government, there's no issues with that going through. So we could expect to see that happen by, I'd say, the last week of May at the latest.
Now that's a quick win. And they did this a year or two ago, didn't they? They reduced HECS debt, or is that an interest rate reduction,
Yep.
indexation change?
What they did last year, it first was announced about 12 months ago in part of the last budget that they were adjusting the indexation rate. So it was as high as 7.1% on 1 year. So for 23 and 24, they adjusted it down in line with CPI. Those refunds were processed around November, December last year. But that didn't affect the overall balance. This is the overall balance for everyone that has an outstanding balance within the next couple of weeks. Now, unfortunately, those that have already paid off their debt, I have not seen anything in writing to say that they're going to pay anything that's previously been paid off. So it's only outstanding debts.
Yeah, so helpful for those with a debt, not helpful for those that managed to pay it off before today.
Unfortunately, no. So this itself is a cost of $16 billion. So it's a huge part of the budget, huge part of their promises. Massive change to how we actually repay those student loans. So previously we had repaid it once your income, actually your total income, so that includes your income, taxable income, plus reportable fringe benefits, plus salary sacrifice, that's your total income. When that exceeded $54,435, you would then progressively pay this back when you lodged your tax return. That was a compulsory contribution. Now that started between 1% to 10% of your total income. What they've done now is they've increased that threshold to $67,000. So automatically less people will be paying this off. Don't know if that's a good idea or not. So you can still make voluntary contributions. That will not negate your compulsory one though. And the other big change is it's no longer a percentage of your total income. It's the income over $67,000. So say if you earn $70,000, you're going to pay the $3,000 portion only. And this is going to be 15%. So everybody's going to pay 15% unless your total income is over $180,000. So it's a massive difference. And the average person on 70,000, they gave this average person example, will save about $1,300 per year. So there is that saving there. But at the end of the day, we are going to be paying less of our help debt. So this is something that taxpayers need to be made aware of, that whilst it's a good thing to pay less, that debt's going to be carried over for longer, and it's going to be over your head for a lot longer. So it's not automatically a win-win if we still have this debt that eventually we need to pay off, and it's still going to get indexed, going to have indexation every single year. So it's important that we start planning how much of this help debt that we're going to pay off, and do some more voluntary contributions at the end of the financial year. You just don't want that large amount just because they don't want you to pay it back. It's not always the best decision.
This sounds like a huge planning, or let's say a bigger need for planning now for people with HECS debts, right? Because in the past, you were just automatically paying it off as soon as you earned the threshold, what was it, 50 or 60K? So now you need to map that out, right? Like if you suspect you are going to be on a very high income, it's probably fine. You'll probably just pay it off. But if you think your income might, let's say be under $100,000 a year for a long time, you could end up with this huge debt. Is that how
Yeah,
you see it?
exactly. You really need to be speaking to your financial advisor, your financial planner, and mapping out what this looks for you, because even though they're trying to, or they may have passed legislation that's not going to affect any home loans, what if that changes in the future? So you've got this massive debt. It's still a debt in your name. We need to still be looking at that and planning how we want to get rid of that. So it's the ownership then unfortunately goes to the taxpayer. And in most cases, what happens is it's a like leave it and forget it, sit and forget kind of thing. We don't want that. We need to start taking that over. So it's personally, I don't think it's something that we can just leave up to the government now. We need to take ownership of this and say, look, this is a debt that we need to start dealing with.
Yeah, huge. Yeah, that is a substantial shift around managing
Massive.
HECS debts. Yeah. And there's also, they've done this twice now, taking a chunk off people's debts. So now there'll be an expectation, in 1 or 2 years' time, is the government going to be in a position to take another chunk off our debt, or are we going to be stuck with it?
And then it leads to the other discussion of, does this mean that debts are going to go up? Like, is the cost of actually getting education going to go up in the future as well? So, but that's another chat for another day.
That's a whole nother topic. Yeah, we'll leave that. Let's leave that one for now. There was a lot for millennials and Gen Z in here. The HECS debt's a huge one. There was also a few measures around for first home buyers, which are also quite substantial. So tell us a bit about that.
So the government has proposed a 5% deposit for all first home buyers without LMI. Now, the government will guarantee a portion of that home loan to ensure that these first home buyers are actually able to get this loan. No details or full details yet of what exactly that means, how it's going to work. Is there any home ownership involved in this? Like, what actually happens? What are the banks going to say about this? Is it, how a lender's going to feel about this? How is this going to affect our lending capacity? So this is all really important, and it's a huge step. Like, being able to do away with LMI is great, but does that mean that our lending power is automatically going to go down? Something that they've not done before. So it will be interesting to see what happens in the next 12 months with this. But the idea on the surface is great for young people, first home buyers, to get into a house. We just have to sit and wait and see what comes of it.
Yeah. So does that mean, okay, when is LMI called upon? Like, it's essentially if, let's say, the value of your house drops to the point where the value of the debt or the value of your home loan is higher than what the actual house is worth. And if you're then in a position where you have to sell that house, you can't pay off the loan. And that's where LMI kicks in, right? That's the insurance that covers the difference.
Yes.
So if the government is now guaranteeing that, there could be some situation. What does it mean and how does it work? And is the bank going to be satisfied that they're not going to lose out for the fact you haven't bought this LMI? Is that essentially how you see it?
Exactly. We just don't know what this means. The negative part of me.
It's not something we've had to worry about because house prices always go up. But
But we just don't know. And you look back to, and I don't want to sound negative, but you look back to the subprime mortgages in the US that actually triggered the global financial crisis. A lot of that was because people just weren't putting deposits, anything like that. So what is going to happen with this if house prices drop or if people are defaulting? So LMI does have its place for people getting into first home buying, for people with investing, all of it. And as a reminder, if you are an investor and LMI is tax deductible, I'm sorry, as an accountant, my brain always goes there. But
Important to know.
it will be interesting to see how this actually plays out in 12 months, in 2 years. What does it mean? Are they taking some ownership of it? Is it going to be harder to get loans? What are the banks going to think about this? It's just so early to actually call, but it will be interesting to see, does this get reflected in our interest rates? We just don't know.
And so, yeah, they're bigger questions. For the first home buyer, you probably don't want to worry too much about that. You're just thinking, will this make it easier to buy my first house?
Yeah.
Um, so there was income limits, right? Like in order to access this 5% deposit scheme,
Yes.
there were tests around how much, like you're only eligible if you earn below a certain level. That's change. Is that changing as well as part of this?
I have not seen the breakdown of that as yet. I've looked and looked and looked, but it's literally one of those ones that they've gone, okay, this is a promise and there's not much on it. Now, where I guess I worry for is investors as well. How's that going to impact investors? So how's that interest rate side of it going to be affected? The whole community, basically, like whilst it's great for first home buyers and we really need to get them in it, but what does it mean for everybody? So all of these policies, whether you're a first home buyer or not, is going to impact you in one shape or form.
Yes, yeah, good point. I think I saw somewhere the income limits are going up, and there's also a maximum size, property value or loan where you can access this scheme. That's going up as well, from what I understand. So it's going to be
Yep.
massively expanded.
Yes.
Again, we need to see the details. But
Yeah, exactly.
if you're looking at buying your first home, definitely keep an eye on this because it could be pretty helpful.
Yes. So with it, we'd expect that the first cab off the rank for them is that HEX help, but this, I believe, is going to be one of the next ones that they look at legislating.
Yeah, awesome. Yeah, some interest rate cuts coming too, potentially. So it might potentially get a little bit easier to get into that first home in the near future.
But we don't
Um,
know once
we
we get
don't
more
know yet.
details of this. Yeah. I wouldn't bank on that yet. Let's wait and see.
That's it. No, just you need a good mortgage broker for this stuff who's across all these
Absolutely.
changes. Yeah.
Exactly.
Okay, so it's first home buyers. Now, more so
Oh,
in
there
the
was,
last.
sorry, one more thing for the first home buyers. I'm just
Yes.
jumping in again. $10 billion budgeted $10 billion to help more Australians buy their first home. It involves providing an extra 100,000 new homes. The government plans to work with the states from July to identify where they should be located. These homes are expected to take 8 years to build, so the scheme will not be completed during the government's first term. That's another policy announcement. $10 billion for an extra 100,000 new homes. Again, more long term, but it is part of their getting first home buyers into homes.
Yes. All right. A few components here. That one's going to take a few years, so we'll see
It
what
will.
happens there. Okay, and more so in past elections, we heard a bit about it from the Greens and so on. They always talk about capital gains tax discounts, negative gearing, blah blah blah. No changes there. Is that right? No changes. CGT and negative gearing concessions.
I wouldn't say that that's off the cards at all. The reason for that is, let's be honest here. They do have a majority, and they did put some allocated spending into the Parliamentary Budget Office to see how changing capital gains or tinkling with negative gearing will affect it. And they did have to come out and admit that they've done that. It's not something that they do all the time. So with the majority that they do have a mandate. I believe that there might be something that they could possibly look at. I would not rule that out at all.
This sounds like a prediction to me, Belinda.
I know. I honestly, I don't. We have tried it before. Okay, so we got rid of negative gearing for 2 years back in the 80s. And what they found is that the rental prices went up. It did the opposite of what they wanted it to do. So negative gearing needs to actually be in place. Now, what a lot of people don't realize is it's actually really difficult. It's become very difficult for investors. So a lot of people have the argument that the investors are bad, this, that, and the other, and housing shouldn't be an investment. So that's a different discussion. But when it comes to investors, there's a lot of things that they cannot actually claim. And the ATO is really targeting investors. They're stating 9 out of 10 investors lodge their tax return wrong, even with a tax agent. Now, the biggest deduction for an investor, apart from their interest, is going to be repairs and maintenance. So we have so many reports of people saying repairs aren't getting done. Most of these repairs aren't deductible in that 1 year. So this is where there's the issue, is that it's getting harder and harder for people to actually afford being an investor as well. So it's not just an easy ride for them. Now, if they do look at doing anything, I believe from the information I've seen, it could possibly be the change to the capital gains discount rather than negative gearing itself, because they've started to rein in that negative gearing. They've got the data matching with the tax returns, and they're really focusing on that. So if they're going to change anything, there could be a 25% reduction of that CGT discount. Or they could just bring it in and wipe it out. But from what I've heard, it's not going to affect anything prior, or there could be a limit to, say, 2 properties. So it's not technically going to be negative gearing, but I believe because they have tried that in the past, it didn't work. And their modelling has shown that there is some movement with changing capital gains tax discount.
Yes. Yeah,
that's my prediction. Yeah.
Yeah, no, I agree. It's been talked about for many years now, and it feels like, as you say, they've got this big majority and they'll have to negotiate with the Greens to get policies through. So it feels like they're not going to be able to ignore those.
The Greens are basically decimated. So it's going to be more the independents. They can pretty much run the show, and they don't need that much support. Now, we don't want to think back to the days of Howard and work choices, but anything can happen with a majority government. But if they're going to go anywhere, it will be after the CGT. Both sides of politics have said that they want to put a 2-year freeze basically on overseas investors. So that's going to be something good, which is going to help. But capital gains tax, mark my words, before the next election, we will see some kind of changes with that.
All right. Well, we'll keep an eye on that. Okay, so that's CGT. Anything else? There's nothing else relating to property in this that's come out of this election, is there? So
not for investors. No.
Let's talk about super. What's happening with super?
So the biggest one with super was the proposal of the unrealised gains, and this is for super values over 3 million. So it's a massive change, and a lot of people, there's been a lot of scaremongering out there as well, but I do see that. I try to look at both sides. I'm not political. And where there is a lot of fear is a lot of property owners, like farmers, are in a situation where they're in that situation, that their properties and their super funds are worth over that amount. Then what happens? Are we going to decimate the farming industry? Now, the talk has been, okay, if we can do this for over $3 million in super, are we going to start doing this for more? Like, where's that cutoff going to be? And is this something, like we think about the average person, they're saying it's only going to be a small percentage of people that are going to be hit with this, but is it something that we're going to expand it and say, okay, unrealized gains for shares or cryptocurrency or absolutely anything? But that's just the what if.
Yes, and it's another policy that has, like, similar to bracket creep built into it. Like, that is not indexed. So $3 million today might sound like a huge amount of money. In 10 years, it's with inflation and everything else, it may not be a huge amount of money, and there's going to be more and more people creeping over that threshold.
And we need to see what industries, and the farming industry is going to be one that it could be negatively impacted by this. So where's the protection for that?
Yeah, no, that's a big one. And then around super, there's nothing else in there, is there? No changes.
No changes.
Yeah. Again, we might see something now that they have this majority. We might see some more action there,
Anything,
but nothing at
anything
the
is
moment.
possible.
Okay, that's super. What other changes do we need to know about that's come out of this election?
Okay, so we do have some tax changes. Now, we'll talk about the $1,000 automatic deduction. Now, interestingly, I'm not saying that they stole my idea, but we did have a video earlier this year, and that's said in full jest. But we've always had a $300 deduction, and it's a deduction, they say, without receipts, but you need to be able to substantiate. So if you are pulled up on it, you need to be able to prove, hey, this is where I've spent the money. Now, we've had this in play for many, many years, and the dollar value in line with CPI would at least be doubled now. So it's something that they should have looked at. So we should have automatically gone to at least $600, $700. So the $1,000 on the surface sounds good, but when they give you something and they say basically you just have to tick a box and that's it, you don't need to substantiate. Nothing in the ATO is ever a non-substantiate. So that $300 deduction, whilst they say you don't need receipts, you have to substantiate. The set rate method with a motor vehicle, you can go up to 5,000 kilometres without a logbook. You still need to substantiate it. So while it's been marketed as just tick a box, you're automatically going to get $1,000, you don't need to see an accountant. It's not really true. We don't know the finer points because there always is when it comes to the ATO. Now, as far as accountants are concerned, before anyone thinks, oh, it's going to take your business, that's why you're thinking like this. Most people that are going to do a $1,000 deduction are not going to be seeing an accountant anyway. So there are going to be some people that will go, wow, this is great. But we don't know until we see what the ATO states about it. Because they're the ones at the end of the day that are going to be policing it. So they can automatically say, we still need to see some written proof. We need to know what you spent it on. You may just tick a box, but that's not going to be enough for us. So don't get too excited. It was a great catchy thing that they could actually do as part of the Labor launch, but it won't, mark my words, it won't end up being what it says it is. And also important that the average Aussie actually has deductions of over $3,000. So whilst this is a shortcut and you think, wow, I don't have to do anything, I don't have to think, I don't have to save receipts, shortcuts never work when it comes to tax. Put the effort in and you will get a larger refund.
Yeah. So is that $1,000? Does that mean it's only relevant to people who don't have receipts to be claiming more than $1,000 of deductions?
Yes. Yes, exactly
Yeah.
right.
So if
So
you've
there's
driven
that.
your car a little bit for work or something and there's a couple of grand worth of
Yeah,
claims there, this is of no use to you. And you're
no use.
saying even if you do tick the box $1,000, thank you, the ATO is still going to say, yeah, how did you get to $1,000?
Exactly. So
Okay, so
what
potentially
they market
meaningless.
it, yeah, potentially meaningless.
Yeah.
And also remember, $1,000 isn't $1,000 refund. So
Mm.
if you're earning under 45,000, that $1,000 becomes basically $180. So it's not. It sounds catchy, it sounds wonderful, but you're not getting $1,000 refund at all.
Okay. And with the tax rates, there was some little adjustments there that are coming in next year. Is that right? With the rates on income tax?
Yes, so this is further to stage 3 tax cuts, which we keep hearing things about bracket creep, and we've had videos on this that we're just not addressing bracket creep. And let's be honest, neither party have taken on board the fact that we need major tax reform in this country. So neither party's policy even touched the surface. So none of this is tax reform. This is a little band-aid. I wouldn't even call it a band-aid from either side. No one did the right thing. So what we're looking at is there's going to be a reduction in the lowest income tax rate. So they're reducing the 16% tax rate to 15% from July 1, 2026. So that's income between $18,201 to $45,000. We're seeing a 1% reduction. And then 1st of July 2027, we're seeing another 1%. So that's going to 14%. Now, this doesn't mean that it's only the low income earners that benefit from this. Everybody does, because we have a slide in tax scale. So your first 45,000, you're going to pay less. So basically they're saying the average tax cut is expected to be around $43 per week or more in 2027 financial year, and around $50 per week or more in 2028. So it's a modest tax cut, and this is part of all of the tax cuts that they've done. This one, we're talking more, that's adding up the whole stage 3 tax cuts with this. It's more like an extra $1 a day, basically, for the average income earner. We're looking at about $7 a week. Grab yourself another coffee.
One coffee a week in
Yeah.
2 years' time. Sweet.
So,
I can't wait.
So it hasn't gone anywhere to address the tax reform that is desperately needed in the country. Another thing that they've done is they've Medicare levy low-income thresholds. So this is at a cost to the government of $648 million. They are increasing the low-income thresholds for the exemption to Medicare levy and the reduction by just under 5%. So that will mean less people will be paying Medicare levy on a whole, and this is low-income earners.
Okay, so what's the threshold there? Like, how much do you have to earn before you then start paying that extra tax, being the Medicare levy?
So basically, for a single with no dependents, we're looking at about 26,000. So that's
About
where
26,000.
Yeah.
Okay.
But once again, none of this is revolutionary. None of this is tax reform. And as a tax specialist, I would have really loved to have seen them take the bull by the horns and say, let's fix it. And no one has.
Me too. Yeah, it's been a long time. When was the last time you would say, okay, this is some real tax reform? How many years ago?
Well, the Ken Henry review was back in 2010, and he came up with a lot of great ideas that neither side have implemented. This is something that we need across the board. So we need to look at GST. We need to look at the GST threshold. We need to increase that from 75,000. That hasn't changed in 18 years. So we're looking at a good couple of decades. I think the last time we actually did anything substantial with tax was honestly, when GST was introduced. It's a long time coming. We really need to do it. But the problem is we're not even addressing bracket creep. One way that they can fix that is by indexing our tax rates in line with CPI. Many countries around the world do this. But the problem is individuals contribute over 52% of the government's receipts. So they know it's a lot of money. Even though stage 3 tax cuts have helped drop the amount of tax we're paying, that's going to be all but gone within a couple of years. And we're paying, honestly, individuals are paying way too much tax, but it's just worth too much for them and they don't want to give that up. Neither party.
Do a lot of countries do joint filing as well? Like your income tax is based on how much you earn as a couple, which is different to like Australia. Here it's all individual based, right?
All individual based. We had a video on this just recently when you need to put a spouse on your return and why, and it's for 4 major reasons. It's your Medicare levy reduction, Medicare levy surcharge. It's also for the private health insurance offset rebate and for the pensioner and spouse offset. They're the major reasons. Now, the other changes that we're looking at coming up to 1st of July is we get there's an annual wage increase. Now, it being a Labor Party, they will be pushing that very hard and high. We would be expecting possibly between 4 to 6%. And for small business owners, we just don't know how that's going to go down. We've also got the final stage of, I believe that went over 12 years of getting the superannuation up to 12%. We had a couple of years on hold there. So small business owners, again, will have to be forking out for the 12%, that extra 0.5%. That being hit at the same time that we've got that wage increase for minimum awards could be the nail in the coffin for a lot of small business owners. We've also got July 1. What else have we got starting July 1? So we've got those award rates. We've got the super. July 1 next year, we're looking at that payday super coming in. Now, right. There's a lot of pushback with this at the moment. So a lot of the super funds and the accounting software bodies are saying we're not going to be ready. And what we're finding is the small business bodies are actually coming forward and saying we would like a 12-month exemption for micro employers, so anyone under 15 employees. So the payday super is basically a massive shift for our superannuation. It's whenever you pay your employee, that's when the superannuation is going to be paid. So normally something like this would be introduced with small business owners. Generally, those under 19 employees would have been phased in either on a monthly basis or actually had an exemption. It's all in at once.
I said a
So
lot of people don't realise it's only quarterly at the moment, right? Like
it's
even
only quarterly.
you might get your pay slip that says we've paid you X amount of super, but most employers won't actually make a payment to your super fund. They'll only do it 4 times a year, not fortnightly or monthly.
And what happens is a lot of employees say, no, my employer's paying it weekly, and they're not, because they can see it on the pay slip. More than quarterly, I think, would help small businesses as well as a small business owner for cash flow. Monthly would be good. I think that would keep everybody happy. It keeps the employees happy as well. But I think it is a bit of a stretch going to that every pay. It's just going to see a lot of pressure on small business owners. Even the extra red tape burden as well. We're trying to make things easier on small businesses. And there's a lot of talk. So the ATO have announced that some small businesses are going on to a monthly BAS, and those are ones that haven't been compliant in the past. But there has been a lot of talk for the past 15 months that monthly is going to be something that they're going to push for everyone. So we are going to start seeing more frequent reporting. That is, as part of the Tax 3.0, that's where they want it to go, that small businesses report more frequently.
Okay, are there any opportunities or positives in this these election promises for business owners?
Nothing that I can see.
Nothing.
But
that's a shame.
I've got to say, on the other side as well, there was the policy of, the meals, actually, with the $20,000 for the meals, which was going to make FBT reporting a bit of a nightmare. The one good thing that this government has done is actually extended the instant asset relief.
Yeah.
They've extended that for another 12 months. What we need to see is this lifted to 100 or 150,000, so we can start getting small business owners to start investing in their business and knowing that they can recoup it in that first year. What can you buy for $20,000? It's ridiculous. So it's going to help all industries. Like if we can get over the barrier of motor vehicles, equipment, all of that.
Yeah,
so if we can lift that.
Car's the big one there, because again, to remind people what that is, that's just about if the business buys something or spends money on an asset, it's about the timing of when you can claim that as an expense for the business. Yeah.
So if it's anything over the 20,000 mark, it has to be done. Generally, the first year is at 15%, and then it's 30% for the following years. So we need to see that lifted. I mean, the car limit is 70,000 for a small business. So why aren't we seeing it at least 100,000? So it just doesn't make sense it being 20,000. But neither party, this election was not about small business, let's be honest. And the budget was not about small business either. This was a first home buyer, Gen Z, millennial election.
Spot on. Okay. Is there any piece of advice you have for people following this election on anything they should be focusing on or thinking about?
Well, honestly, the major piece of advice is definitely around that. If you have a help debt, I think it's time that you need to start speaking to your broker, speak to your financial planner about what you're going to do to actually tackle that. Don't just see this as, wow, this is extra money for me, because further down the line, this is actually going to hurt you. So I think we need to start taking the ownership of this debt and see it for what it is. It is a debt that you're going to need to pay back. So we need to start addressing that differently.
All right. Well, I think that's a good that's probably the main key message I think, out of this election and the impact it has on individuals is that help debt issue.
Yep.
So thanks for that, Belinda. Thank you so much for coming onto the podcast. Elections bring change, but your financial strategy should be built to weather whatever comes. Stay informed, stay flexible, and remember the best financial moves aren't made in a state of panic. They're made with a plan, especially when it comes to HECS debts. If this episode helped you feel a bit more steady after a chaotic election week, hit follow, leave us a review, and share it with someone else wondering what to do next. Thanks for tuning into the Winner's Playbook. Catch you next time.